Welcome back to the Investor Empowerment Series radio show. This is episode number 48. This is live from IMN, the actual panel that I was sitting on during that conference. It is entitled Rental Home Disposition Strategies. How are you making sure you aren't leaving any money on the table? This session is actually pretty interesting because it's hosted by, the panel is led by RJ Palano out of Florida, who runs the bulk of his business actually out of Atlanta, Georgia. He's a turnkey provider, rental home investor. He's got a lot of good insight as to what's going on currently with the acquisition and disposition in our current rental market. You'll hear me perk up in the beginning discussing about acquisition strategies, actually, not so much disposition, because the majority of the attendees at this conference were more concerned with finding assets as opposed to disposing of them, as you could probably imagine. Given the state of our current market, it's not too hard to sell a house right now. So thank you again for coming back and listening. Please give me some ratings on SoundCloud, Stitcher, iTunes, YouTube, Google Play, and enjoy your panel from the IMN Conference, Single Family Rental Forum, IMN East.
Welcome to the Investor Empowerment Series radio show, empowering your real estate investing with techniques, opportunities, and information, minus the BS and sales pitches. Now, please welcome the host of the Investor Empowerment Series, Joe Mueller, from the Tough as Nails Investment Syndicate. Joe Mueller.
It's nothing earth-shattering, but everybody knows that the market and the market conditions have changed significantly over the last few years. As I look up here at the panel, 4 or 5 years ago, I sold over 100 houses, all rehab, turnkey, over to County. I think that was maybe even before Josh was there. I've sold houses on Investability through Altisource. I put stuff up there, and it was pretty smart. They bought the stuff right away. So your greatest resource in here is the people you're sitting around, as well as people on all the panels. In the other room, Roofstock, we recently put some stuff on their website, and they sold it right away as well. So it behooves all of you to really make inroads with the people around you and find out what people are doing and what's changed, because every single market is different. Now, they had a whole list of questions here, as you guys know, things to discuss, and I think by just opening it up to a couple of questions, we'll probably get to all these answers in one way or another. So, Paul, we're going to start with you on the end and speak a little closer to your mic. If anybody can't hear, just raise your hand at some point, because sometimes we're all stepping away. We don't even realize we're doing it. But, Paul, for you and everybody else on the panel, what has changed the most for you in the last 12 months for your business, your view of business, and what you guys are doing differently? And a lot of that will probably incorporate some of the stuff on the sheets that they...
So I think one of the things we've seen change on our SFR portfolios that we've been selling is, one, the seller expectations have increased on what their pricing is. They're trying to compress the gross yields, making it much difficult for a new buyer to hit the kind of returns they're looking for. What we've also seen because of that, or in part where we see an opportunity, is some of the larger groups that acquired everything a few years ago are now becoming more selective, much more selective, and trying to move to A, B+ type assets, and they're willing to prune off their C-class assets. And the buyers for these C-class SFR portfolios where we transact are typically high net worth individuals. So they can't take down 100 properties per se, but we can do several transactions of 30 to 50 properties. So when I represent an institutional REIT that's looking to move off C-class, typically the buyers we're bringing in are SFR syndicators as well as high net worth individuals. We're able to do that and still hit the numbers they're looking for. But I think as we go in this year, other markets where we're listing portfolios, seller expectations, because the retail values continue to increase, they're seeing the appreciation that's coming, but unfortunately a lot of times their rents may not be high enough. Their rents have gotten behind over the last couple of years, and so it's not keeping up with where the value is on an income basis.
Coming right down this way, Josh, you're up.
All right. Well, I mean, obviously for our company, coming from a private facility merging into the Starwood facility in a public market was a big change for us specifically. But I think more specifically to what we've been seeing in the market, obviously there's in our target markets, the high growth kind of Sun Belt region, there's a lack of available inventory, and I think you see that across the board. specifically on the single asset side. And there's a lot of competition out there today. A lot of capital's coming into the space. I think that's a result of just the public's trading a lot better. I think the markets are realizing that this is a legitimate business that can be run professionally, and you can have long-term solid yields driven off these platforms, which has thus increased the amount of capital in the space.
Go ahead.
We on our side, we've really seen a shift when we're selling these larger portfolios and the approach, from the buyers coming to us. And early on, I think they were expecting deep discounts as if you were buying distressed real estate, where the reality is these were institutionally rehabbed, leased up, stabilized assets, and getting away from the concept of, hey, I can buy this at a 15% discount to the retail value, versus no, this is a solid, stabilized, cash flowing property today, and it needs to be thought of on a cap rate valuation instead of what's the discount to retail. And a lot of times we're able to transact at or above retail prices because we have solid rents on the platform. They know that we have solid residents in the homes, and really at the end of the day, if you're a cash flow buyer and you're able to step into a stabilized portfolio, from my perspective, I think that the retail is just a gauge of where you should be, where you should be from pricing, more or less.
Josh, just a quick question to clarify for the group. Where are your top markets right now that you guys are still investing in?
So we're currently active. Our acquisition strategy has been to continue to buy in our subscale markets, which are Charlotte, Raleigh, Nashville, Phoenix, Las Vegas, and a little bit in Denver. So we've since expanded and started buying again in Dallas and Atlanta as well, just given the capital that we're sitting on and needing to deploy that.
And just so you guys know, if you've got turnkey properties, Colony was so easy for me to work with years ago. And the first three cities that he mentioned, they weren't in those cities when I was doing business with them. Charlotte, Raleigh, and in Nashville, they were not in those cities at that time. So you can see their own dynamics are changing because they can't get inventory. And something else I just have to point out, he says they're often buying at retail, okay? Retail, maybe even a little above retail?
I said selling.
Oh, selling. They just don't know they bought retail from me a few years ago. No, I'm just kidding on that. Josh, bringing it down. Doug, it's up to you.
I think we were a little different because our start was non-performing loans, and that's exclusively what we did until Dodd-Frank. And so the biggest change in the last few years was, we'd been killed by Dodd-Frank and similar legislation. We were just getting legislated to death in handling and collecting our own loans. Our cost was going through the roof. Not trying to be political, but the election surprised us, I think everybody, and it dramatically changed the game for us in the non-performing space. We had almost completely gotten out of non-performing loans because the price was just through the roof. A lot of the bigger funds were pushing the price way up because they, once again, had to deploy capital. But they've started to ease back off of that, and the legislation, I wouldn't say the legislation, the regulation, the regulators have changed their tune a little bit with the newest administration coming in. They've loosened up a little bit to where it actually is very profitable for us to start going back in. So we're actually moving away. We had moved away from the non-performing space and into the traditional spaces that we're talking about, whether it was rentals, fix and flips, those types of REO buying, normal activities that most of the people at this conference does. And then with the lessening of the regulation, we've really started to move back into the non-performing space. The other change that we've seen recently is we have some severe concerns about the future of the economy with respect to real estate. The S&P numbers just came out at an annualized rate of 0.7%, which is unbelievably anemic. But the S&P has jumped in the last 12 months by 17%. New housing starts, I'm just going to talk about Florida. New housing starts last year were 1.2 million on an annualized basis, where the population was only growing at 350 some odd thousand. So the demographics long term are concerning us a little bit, so we've started to get a little more conservative with some of the investment strategies that we make.
Go ahead, Joe.
I'd say the biggest change that we've kind of seen in the last year due to the lack of inventory is the acquisition strategies and the methods we need to take on in order to acquire the properties for the same type of discounts, or at least some type of discount, as opposed to paying retail prices. Even I think a lot of people in this room are still kind of focused on the online platforms that are selling these properties, auctions, judicial sales, MLS even. We created an in-house team that basically is using direct mail, bandit signs, pay-per-click type methods in order to acquire these properties, direct from sellers, as opposed to going through more conventional methods, I would say. Just becoming more challenging, so that was the way we got around it. We still have investors that are able to acquire, obviously, on the MLS, but a lot of times they're paying higher pricing. As a broker, I keep my eye on that pretty closely, and I found more success in the direct mail or direct seller type purchases than anything the MLS even offered 5 years ago, or the online platforms that you'll find nowadays. Locally, judicial sales in Chicago, there's guys paying 20% over market value to get a property. I don't know if it's anybody here, but that's just what we're seeing. We show up to buy a property, and you got somebody we've never seen before that pays $25,000 more than the property's even worth in its current condition. So different methods to acquire. Get creative.
I would say from my perspective, our perspective, we're a little bit different in that we're not, like I said, we're not an aggregator, we're not an owner. We're working with a lot of the people here standing up here with me today, and a lot of your other peers to sell their inventory. But so really, there's from a change perspective, I think there's three main areas where I have seen a great amount of change, and that's again mimicking a lot of the sentiments that were already set up here. But creativity, getting more creative with your acquisitions, really looking at more data-driven decisions on how to identify properties that are available for sale, and maybe being a little bit more upstream, like we talked. They talked about that in the morning session. People that are successful at acquiring more inventory are getting further upstream in the process, and using more data solutions to identify the properties that might be available for them. And on the disposition side, we ourselves have seen a big change in the strategy for how we're selling our inventory. We have a lot more boots on the ground efficiencies than we had 12 months ago. We're working with a lot of foreign investors, just like you said earlier, RJ. We're really diversifying the buyer pool that we're selling the inventory to, so that we can achieve the best yield for obviously our sellers and get the diversification in our buyer pool as well. And self-directed IRA clients as well, doing a lot of education with them and mentoring them and showing them how they can use the assets they already have to build their rental portfolio. So those are the biggest areas we've seen change on the acquisition and disposition side. And then, mimicking what Josh said earlier is geography. We're not seeing inventory just in Atlanta, just in Dallas. We're seeing a lot of available inventory for us to sell in Birmingham and in Nashville and in Charlotte and Raleigh, and some of those markets that historically to date have not been extremely strong from an investment standpoint, from an acquisition perspective.
Fantastic. You can see by the answers and the responses here that there's a tremendous diversification on this panel. I got to think that I'm probably the only guy that's been doing it, though, for over 35 years in here. I don't know if anybody else over 35 years. I don't even think some of you are 35 years old. But the thing is things are always changing, okay? And business is really about two things. Somebody has something, somebody needs it. The rest of us just want to interject ourselves in the middle and get paid for bringing the two parties together. That's really what it's all about. And it really starts, as Joe was pointing out, it really starts with the lead generation. If you can't get leads, you got nothing to sell. And if everybody's fishing in the same pond, how many fish are you really going to catch? It was really the funds that came into play, Blackstone and Colony and everybody else, Waypoint, American Residential. And I built over 100 houses for some of these guys with actually the builder that I did the deal with is actually in the room, John Voitas. He's either here or he's around somewhere. But the point is it's always changing. The dynamics are always changing. Everything is changing again right now so rapidly. I assure you, none of them have a crystal ball. Neither do any of the other speakers that have been up here today or that you're going to see. But we can make and draw some logical conclusions on what you guys can do to help you make more money, because really that's why you're here. How do I make more money? How do I adapt to this marketplace? So we're just going to go off grid for just a teeny second here, and then we'll come back, and we're going to leave time for questions as well, because I think it really starts with where you get your leads. And you, please correct me if I'm wrong. If I start with Josh down there, Josh is mostly, they're getting their houses from other providers throughout the country. Is that right, Josh?
Correct, yes.
Do you have people on the ground buying houses in specific cities, or you just have turnkey operators and aggregators that are working for you?
We have boots on the ground that handle our local market acquisitions. But look, we look at we look at turnkey providers as well too. We don't have any long-term relationships, but we'll look at taking portfolios out. We've been active on the build to rent and working with home builders as well too. We've got a very robust pipeline of new construction on our acquisitions, about $200 million over the course of the next 18 months of deals coming through that channel. So, look, as the market's changed, you have to get creative with how you're deploying. So we've approached it from every angle possible to make sure we're finding high quality assets that still yield.
Sure. And being in a hotbed like Atlanta and in Tampa, Sarasota market, we're at the auctions. The auction, Big Tuesday, is tomorrow. Super Tuesday, they call it in Atlanta, and I'll have people in 10 different counties. But I looked at the inventory. The inventory is so freaking low this month. It's the lowest I've seen in 5 years. That pond has dried up tremendously. That's why the funds, they're having such a difficult time finding inventory. It just doesn't exist anymore. You have to go off grid. And that's what we've done. And I think Joe mentioned it. He's doing a lot of direct mail marketing. I think I heard him mention bandit signs, pay-per-click. We do all that stuff. One of the guys that works within my group, he sent me a text the other day of, you ever see those guys with, I guess they call them spinners. They dress up like Spider-Man and they're trying to get you to buy gold or something. He's doing it for people to buy houses, and he got 2 leads. And he bought 1 house, actually bought 2 houses, actually. And it only cost him about $300 per lead based on what he had to pay the guy, which is a great return on your money. Joe, let me bring that to you if I could. On the pay-per-click stuff, do you have any idea what your costs are per lead and per acquisition?
I don't have those metrics handy, but I can tell you more on like the bandit sign, direct mail campaigns.
Would you please? Because I think that's really useful information for
something
everybody.
Interesting that we started, like I said, about a year ago was this bandit sign thing, which I've been seeing since I was a kid, posted on telephone poles throughout everywhere I've ever lived. We buy houses cash, yellow signs, black letters. So I followed suit with it, put a team in place. We're paying about $1.50 per sign, about $1 to install. And that is every weekend, Friday night, I got a guy that runs out and puts out 200 signs. And our return on investment is about $150 per sign installed annually right now. Direct mail return, we're probably average. We're getting between a 2 and 3% return on our direct mail campaigns, and that includes yellow letters, postcards. We do like a more professional corporate mailer with more branding because certain people look at whoever's contacting them in a different way. Some people don't want to deal with a large company. Some are older, 55 plus, high equity type owners. They'd rather deal with like more of a single individual or husband and wife type team. So we've kind of split tested different ways that letters can work. All of them work. So we consistently just hit up these lists that are public record essentially, probate, inheritance, vacant houses through one of the methods I'm able to get that list is actually from the city directly, condemned house lists, things like that. Some of you got to get Freedom of Information Act applied for to obtain those lists, but tax delinquents, things like that. And it all added together, if we're mailing somewhere between 5,000 and 7,000 pieces a month, we're acquiring between 2 to 3 houses at a minimum per month on a bad month, and sometimes as much as 10 to 12.
I have to tell you, that is work, what he's doing. This isn't for the faint of heart. If you really want houses in this market, it is not the same old game that it used to be years ago. You really got to go out and get them. And he's actually getting a great return for his dollar on that. I don't think our returns are anywhere near that good, but I think I might be in hotter markets. Atlanta, we sent out 60,000 postcards. Well, if you can send 6, you can just add a zero. 6,000, 60,000. And our return,
we're just
candidly,
not there yet.
What's that?
We're just not there yet.
Well, listen, I'm not sure that I'm there anymore because it was a terrible rate of return when I really took a good look at the numbers. The pay-per-click works pretty good. We do something that's a little bit different. We do TV. And that rate of return is pretty good. And it's pretty interesting. When you think about all the available things that people have to them for television these days and stuff on the internet, it's amazing it still works. 8 years ago when I was doing it in Atlanta, we killed it. Literally killed it. We're not killing it, but it's still working. Anybody on the panel doing anything else to attract properties to buy that we missed? I just want to make sure we covered it pretty good. And then if you guys got questions at the end, you can ask us about that. Anybody else?
We have a lot of data that we can customize and provide lead lists for those type of direct mail campaigns and for those generation tools that we can actually customize based on a lot of the different transfer records that we aggregate. So Investability, sister company is Rent Range, which is a data company that's been aggregating transfer records and rental data since 2009. So we see a lot of people use our data for those reasons, to identify different types of inventory that they can reach out to the owners and search directly, more of a Homevestors model, reaching directly out to an owner of a home in certain markets based on certain criteria that you can kind of let us slice and dice for you. So we are seeing a lot more of that, not only in the acquisition side, but for other vendors targeting other types of clients as well, that we're seeing a lot more demand and requests for those types of lists coming through. So.
Now, a lot of these lists, and you can buy them from a lot of different sources, and often they're time sensitive. Clearly, if it's a mortgage foreclosure list, it's only good while the people are in foreclosure. Brittney, I'm curious, do you have a list, or do you guys get a list for probate?
We could. We don't productize that, but we have the data to be able to pull that out, yeah.
Probate is really probably one of the best places to buy houses, and the reason it is because the people that inherit it, they really don't have anything invested. Okay, those are the types of deals where you can really get some bangers out there that make a big difference in what you've done that month. Something else that we just started doing, and I used to do this years and years and years ago up in New York when I was up there, and that is we would have somebody at eviction court waiting for the homeowners to come on out and see if, give them your business card, because many people, that eviction, that's probably the last one they want to do, and or housing court. The funny thing is, if you do that in housing court, you often, if you buy enough houses like that, you end up in housing court, and eventually they think you're a bad guy. We did that so many times, they thought I was a slumlord at one city at one time, because we were in housing court, as the newspaper said, more than anybody else in 33 years. But they always miss the important stats, is, wait, our stuff didn't fall into disrepair, that's how we bought it. Okay, Doug, I know this is a good question for you. Institutional selling or otherwise?
When we were spinning off so much product and paying realtors so much money to sell our product that just in the state of Florida, my wife is an architectural interior designer by trade, very outgoing. In the past, she had sold medical sales, that type of thing, but she had a very strong background in construction, and she actually stepped in and was working for Castle Rock, helping us manage construction crews on a national level, and did a fantastic job. And I said, we're spending so much money on realtors, why don't you go back and get your real estate license and start our own brokerage, which we did. And so it was pretty amazing. But what we found through that process is that we take everything retail at this point. From an institutional standpoint, we tried to bulk things together and sell them. But what we found was we got a better return on our investment when we actually took everything to retail. Now, there are times where we don't have good boots on the ground with perhaps we take a loan, a property back in an area where we don't have good boots on the ground, then we'll typically sell that off almost on a wholesale type of basis, or maybe to someone we already have a relationship with. But 9 times out of 10, we actually, whether it's our own brokerage or a broker that we have in a local city, we find that our return is better by taking it retail.
Anybody else have anything they want to add to that?
Yeah, I'll add to that and maybe answer the question of how do you not leave any money on the table? But I think to your point, you've taken the time to build the infrastructure around that single asset disposition strategy, and capturing some of those fees, those brokerage fees that go out the door if you're just a normal seller. We see on our side, just from an active buyer portfolios and an active seller, for example, last quarter, I think we looked at over 40 portfolios and transacted on 2. And a lot of what we're seeing out there is just lower quality product. You start to dig in, and the diligence is just a mess. There's no records of leases or move in, move out. So you're really thinking, you should be buying a fully stabilized portfolio, but at the end of the day, rents could be 15% below market. The leases are a disaster. There's been no consistency on how do you screen the residents. and then they want to say, okay, well, let's get a full retail or value for this, or trade this on a cap rate basis, and you start to dig in, and you really can't get there from an institutional standpoint. I think if you're thinking about selling the portfolio, you have to decide, are you going to do a portfolio transaction, are you going to do single asset transactions, or are you going to do a combination of both? And I think the sellers that have more flexibility in that area are going to see the greatest returns, because there are times where you're going to be able to avoid a lot of friction cost on a portfolio transaction, but you need to have the portfolio well organized, ready to go, with information at your fingertips, so that ready, willing, and able buyers can quickly access that and make a bid on that. And in fact, I think engaging with the brokerage firms, the SVN, I know HFF is active, Investability, and even Roofstock, they can really help get that organization up front. And while you may think I'm paying the brokerage commission, I can guarantee you'll make it back in the sales cost by maybe even taking it offline and getting it stabilized over the course of 6 to 12 months before you bring it to market.
Yeah, and to dovetail with that, two things to add. Really, the first thing would be, I mentioned we take everything retail. We do have the resources to be able to do that. We've honed our craft. We only use certain types of cabinetry. We only use certain types of tile. We only use certain types of paint colors. It's all very, the grout lines have to be a certain thickness. So everything is very, I hate to say it, this came from being over 20 years a banker. We're very anal retentive. So when we do present something for sale, we've got our ducks in a row. We don't, for lack of a better term, half-ass it. It's done properly. And through the real estate brokerage part, it's grown to the point where we're doing a lot of work with John and Mary Homeowner or other small investors in the Tampa Bay area who are trying to sell their product through us, and we see some very shoddy work that's being presented. And those properties do not move as well. One of the things that we did find is that somebody a long time ago said there's two people you pay, your lawyers and the tax man. Paying a really good professional to be able to sell your product is critical, whether it's going through Brittney or you find that fantastic real estate agent in a local market that you have a great partnership with that understands your products, and I'm sure you could echo that, whether it's SVN or whoever. Having that expertise is critical. And I don't want to pay the 5 or 6% to an SVN or a Castle Rock group or whatever. You know what? We probably are yielding you 15 to 20% more on the product, as if you went out and just tried to halfway do it. I know a lot of larger people that when they try to go out and sell, particularly the REO type of folks, they've got it in their head that they'll pay an agent $500 to list it on the MLS. Well, what you get is the cream of the crap as far as being able to market that. So do you think those people really care what you get out of it if you're paying them that poorly? People work for you if you pay them, and you get what you pay for.
I would say, RJ, it's more nuanced depending on the price point and depending on the market and the geography. We had a 53 home portfolio in Dallas last year, closed it in March, and it closed 400 over appraised value. Now that portfolio, average rents were under $1,000, and we were able to sell about $83,000 a door, and it was $400,000 over appraised, and it had at least $500,000 in deferred. And one of the large benefits for that owner was A, he could now do a 1031 because he had 53 properties closing in one transaction, so there's tax advantages there. But B, that the buyer was trying to accumulate 100 houses, and he'd been accumulating them from wholesalers one-off. And he was just getting tired of it. He had his own business. He could overpay for those assets, and he was doing that knowing he was overpaying because his bank made him put up an industrial building. He had his additional collateral when he was doing that, because he doesn't have the time to go find 53 properties. And if he's trying to build 100 homes before he retires in 5 years, he's willing to do that because he knows the market's appreciating. So, I think when you're looking at homes valued definitely under $100,000, there's probably a strong case that on an income basis you can sell those at retail or pretty close, and sometimes above, like we did in that example. Once you start getting over, again, depending on the market, over $125,000, then you can really look at, now your buyers are a little more qualified. The retail may exceed what the income is, but to the original panel's question of how do you increase, how do you not sure not leaving money on the table. The number one thing when we're doing broker opinion values for owners, the number one thing that we see on rent rolls is under market rents, because we'll do a rent survey for them. And the problem we have is a lot of buyers, whether they're large or even more importantly when they're larger, institutional buyers, they have their own OpEx. What they're looking at, the number one metric they're looking at is the current gross yield based on current rents. So I have a portfolio that said averages $1,000 a month, but market says it's $1,200. Yeah, as a broker, I'm going to try to bridge that gap for you and get you to someone to pay maybe prices based on $1,100 a month in rent. But it's really hard for some buyers. They will not do their valuation on anything other than the current rents. They don't care what the value add story is. So that's the number one thing we're looking at. We're doing a BOV. Let's look at the rents, and if you have some time, let's try to get your rents up. Or throughout the marketing process, if we have a 6-month listing, I can able to show buyers, here's where the rents were in January of this year, and here we're now in February or March, and see he's bumping rents up on average on renewals, on the month-to-month tenants. We're getting another $50, and then we can start selling them on. It is, in fact, under market. But that's the number one thing I would say. Second, the financing's changed a lot. And we try to spend time when we're doing our offering memorandums to find the best lending sources for assets. And sometimes that can help create value if the buyers weren't aware of lower interest rate products. There's both the national SFR lenders, which are great, which has made the local banks and a lot of these markets more comfortable with SFR portfolios. And depending on the buyer's preferences and aptitude, they could look at some recourse options, get a much lower interest rate, but then they're giving up some on the AM. We're seeing local banks only doing 20 or 25-year AMP. In some cases, depending on the buyer's objectives for that investment, they may be more concerned with equity buildup necessarily than cash flow in some cases, depending on what their outlook is for their time horizon. So we spend a lot of time on the lending side when we're doing valuations to see if we can create value that way. And then finally, if we have an owner who's willing to manage that portfolio for the new buyer for 1 or 2 years. If that buyer's from out of market and don't have a presence there yet, that can sometimes help. They do discounted property management for a year or two. We see that adds value as well.
I'm going to clean up a little bit of what they said because there was a lot of great information there, a lot of words, and I'm going to just bring it down to the simplest words of what they said that I got out of it. And I'm going to start with Doug. Doug was talking about he moves stuff inside. He's selling retail, okay? I'm actually doing the same thing in Atlanta as well as in Tampa. We can sell a lot of stuff through Altisource or Investability or through Colony. We can sell through them still, but some of the better numbers are significantly higher if you're going retail now because the market has caught up with us. What Paul was just saying there was he's looking for value add. If you guys got a portfolio of houses, he's looking to see if you guys missed something. Okay, maybe you didn't raise the rents. And years ago, when we first started in Atlanta, we were putting everybody on a 3-year lease because we don't want people to move. Okay, we don't want them to move. We want them to have that psychological feeling that they're going to ultimately own the house, so they'd all have an option to buy as well. But we had to change that about 2 years ago. So we messed up, guys. Our rents are going way past us. Every lease now has an escalation clause of 5%. Every year for those 3 years. We still want them in there for 3 years because turnover is the most expensive cost in this business. If you do it long enough, you will know that turnover is expensive and it kills you. Let's see, there was another really good point up there. It was Josh. Josh was talking, what I'm going to distill it down is the way I received it. He was talking about people should really think about their portfolios. What you should think about when you're going to sell it. Well, you should think about it when you're going to build it. What kind of a portfolio are you going to build? There's the A properties, and there's, let's forget B, there's C's, okay? C's are those lower income houses that are going to typically have a higher yield, but along with that comes higher management, higher maintenance, more aggravation, much more challenging. I live that life. I used to have 350 of those. I don't have any anymore, but that's a different life from going to low yield or a higher yield to a lower yield with some appreciation attached to it, which is what we do in Atlanta. The stuff we buy in Atlanta, we don't buy the really expensive stuff unless we're just going to retail it, $400,000 and up. But that stuff, the sweet spots are still $100,000 to about $160,000, but we'll still go above that. But they don't rent for a 1% of the gross anymore. They're coming down, but they're still going to catch up. When the funds first came into the market and we saw what they were doing at the auctions, I thought they were out of their minds. I thought these guys have no freaking clue how to manage, how to do anything. When I went to Colony's office the first time and I met with a gentleman named Dave Millard, I was there in September. They had 160 people there and they are all new since March. I don't even know how you scale something that fast. Well, it just goes to show my limited intellect. These guys were all right because time cures everything. The values went up, the rents went up, the market's up. Blackstone, all of them, they all killed it. And they get money for a lot less money than we get it for. So they're in the game for a long time, but and what they've really done is they've really made single family house investing, it's like a household investment now. It's not just like buying stocks. And I'm going to just make two other points. Again, the people in this room and some of these people that are in the other room, we started using tenant turnover for processes and scaling up our rentals, and it's working out really well. If you guys have a lot of houses, you just might want to check with them. And the one point I want to make before we open it up to questions is this. If you're not using your 401k and your IRAs and they're not self-directed, you're missing the boat. This is the safest place to have houses or notes or something that you can, take your chips off the table, and you've got this stuff for your retirement, because as we know, business changes all the time. You really need to take some chips off the table, and this is probably one of the safest places to do it. So with that, questions, and you can ask them specifically to anybody. Just, here we go.
Well, typically when we get it back, it's vacant. I'm sorry? He was asking about us, do we take and get it ready to put a renter into it, or do we just sell it? 9 times out of 10, we get it back, and there are warts on the property. Keep in mind, these are foreclosures, and people just don't care about something that they're not paying for. So they'll walk away. There might be some issues with the roof. There might be some issues, within the house. But what we found is if we spend a little bit more money and take it retail, depending upon the neighborhood, obviously, it's got to be completely appropriate. We usually don't put somebody in it when we sell it. We usually sell it off and let whoever buys it from us. A lot of times it's a family, if somebody wants to move into it. And I think a lot of it depends on the location of the property. Is it in a great school district? Is it a higher end type of property? Then we're definitely taking it retail. But somebody in here mentioned the old metric of 1% rent. Sometimes that's hard to achieve on the higher end stuff, which is kind of where we focus. We typically are maybe north of the 150 mark on the values of the properties that we buy, where sometimes the lower value band, it's easier to get a 1%, like an appropriate rent yield. So usually we don't put anybody into it to rent. And honestly, we don't have the infrastructure, the property management infrastructure within my organization to be able to really manage that.
I'm just going to really quickly, we have a couple of investors that we've looked at portfolios for who don't actually have a rental strategy at all, but they had inventory in really strong rental markets where we knew, even though they were vacant and ready for retail, they weren't moving on the MLS, and we knew we had investors that would come and take those that do have their own property management, and they want to do their own tenant screening and their own leases and all of that, and there is a market for that as well.
When we rent, it is typically because we couldn't sell it retail. So we'll put somebody in there to be able to start making that a performing asset instead of just an albatross around our neck. And then at some point, we can cash flow it, and it seasons, and we can sell it off to an investor at that point.
Good answer. I think we got a question. Last question right here, and then, guys, we're going to be around. Guys and ladies will be here outside. Approach us during the week anytime. Go ahead. Okay, the question was, at what net portfolio yield do we see institutional buyers buying at? I think we'll go right to Colony over here because they're institutional buyers. What is it, Josh?
I mean, that really depends on the market. I would say in California, where we expect higher growth and stronger HPA over the course of the next 5 to 10 years, you could buy down to a low 5 cap rate. In markets like the Carolinas, Atlanta, Florida, we're still looking for the high high 5s to low 6s.
In Texas last year, we sold to an institution sub 6 cap on T12. Again, a good growth market, Fort Worth, Texas. But again, it varies depending on the market. That'd probably be one of your more aggressive cap rates for institutional buyer. Other markets, they may want a little higher cap rate. They're really looking at the yield because they have their own OPEX. Some may not have full-blown insurance like the current owner has. So the T12 cap rate, while it's a good metric for multifamily valuation, sometimes with SFR valuations, it's a little clouded. So it's kind of hard to answer that question. You'd have to look at each different buyer, but they're looking at the rents, and they're going to have their own OPEX, which
you have to
probably
look
a
at
lot
the value
different.
of the property as well. I mean, we see from our standpoint on dispositions, when we're looking at inventory to sell, we also take into account the value of the asset in combination with the yield to make sure if it's a lower value property, we'll take a higher yield. If it's a higher value property, we'll sell something with a potentially lower yield.
They were within about $4,000 of full retail when they bought it.
Cap rates typically have been compressed over the last few years, unquestionably. I think Josh's answer was right on the money, and it's pretty much the answer that answers every single question you guys have now or ever will have. It all depends. It all depends on the market. It all depends, the question was whether you rent it or whether you sell it. It all depends. What's your model? What are you trying to do? Sometimes it's so much easier and quicker and faster and cleaner and more efficient to just wholesale something and let somebody else deal with the headache. Okay, once you go full bore and you're putting a tenant in there, well, the best way to keep a good tenant is to have a good house so you don't have problems. So all of our houses, when we do them, they're all pretty much the same. Same carpet, same tile, same lino, same paint, same flowers, same everything. We try to keep everything similar because it's blow and go. Get in, get out, get it done, and move on.
Thanks for listening to another episode of the Investor Empowerment Series radio show. Be sure to tune in next week for another empowering episode. We welcome your feedback, so please rate us on iTunes and Stitcher, and visit us at www.investorempowermentchicago.com or tannisgrouprealty.com.